This is Wall Street Examiner Fast Facts on the web at wallstreetexaminer.com. It is June 4th, 2014. I'm Lee Adler. Here are the facts on yesterday's release of Commerce Department data on factory orders for April. The Bureau of Economic Analysis reported a 0.7% gain on a seasonally adjusted basis, not adjusted for inflation. That would be 8.4% annualized. The consensus expectation of Wall Street economists was for a gain of 0.5%. This report beat expectations, therefore the market viewed it as a positive. However, as always, that wasn't the whole story, and as is often the case, it was misleading. Here are the facts on that report. On a not seasonally adjusted basis, and excluding orders from the U.S. Department of Defense, non-defense factory orders adjusted for inflation and reported on an actual not seasonally adjusted basis rose just 1.8% year over year. Here's what that looks like on a graph. The green line represents actual non-defense factory orders as reported by the Commerce Department on a monthly basis. From April of 2013 till the current release for April 2014, the gain was 1.8%. Compare that with the reported gain in the headline data of 8.4% annualized. The difference is stunning. Some of it is accounted for by the purchase orders from the U.S. Defense Department. Some of it is accounted for by inflation. But the 1.8% gain in non-defense factory orders is indicative of the real level of economic growth. At the same time, this red line shows the Fed's system open market account, the amount of QE that has gone into the system since the beginning of this chart in January 13 until the current June 2014 date. The gain from April of 2013 until April of 2014 was a whopping 38%. That's right, the Fed's balance sheet has grown by 38%, while non-defense factory orders, the actual volume of those orders, has grown by just 1.8%. This is a chart of the S&P 500 superimposed on the Fed's balance sheet, the amount of QE that has gone into the system over the past 16, 17 months. While QE was growing by 38% and non-defense factory orders were growing by 1.8%, from April 2013 to April 2014, stock prices were growing by 18%. So that's 1.8% for factory orders, 18% for stock prices. Stocks rose 10 times the increase in factory orders. But hey, it's all good. Business is lousy, and there's tons of excess labor. With ZIRP and QE, CEOs can cut workers and suppress their pay to keep profits looking good, while using the free money from the Fed to buy all their executive crony stock option grants. A little more leverage is always good for the balance sheet, you know. That's how it's supposed to work, right? After all, figuring out how to transfer wealth from the middle class to yourself is hard work. And you wonder why Bernanke gets a cool $250,000 for an after-dinner speech. He's a genius after all. You take care of your friends, and they take care of you. Sort of. After all, a $250,000 here and there isn't even an 18% tip for good service. This Wall Street Examiner Fast Facts has been brought to you by the Wall Street Examiner Professional Edition, focused on the analysis of macro liquidity and market cycles for professional investors, traders, and sophisticated individual investors. Try it risk-free for 30 days at wallstreetexaminer.com. Get the facts. WallStreetExaminer.com.